Okay, good morning. This is Ralph Mendez. Because we're going to be having guest speakers, um, let's go over this Chapter 18 homework. I can help you solve it. So, number one, what's the contribution margin? Remember, we're doing investment analysis. And it's called the variable method. So, complete the contribution margin for the following data. So, the contribution margin, you have the sales and variable costs. So, you take the sales minus the variable cost is equal to your contribution margin. Now remember, we looked at an article, and if the sales for pizza, and then what do the pizzas cost, then that's your contribution margin. So now that's is a dollars, and then they want you to do it as a ratio or percentage. So you would take your contribution margin divided by what? Your cost or your sales? Yeah, divide by your sales to get the percentage that the contribution margin is of your sales. So 2279 divided by 5,300 sales will give us 43%. So we make 43% on our pizza. So the pizza sales for $10 we make $4.30 if you want to look at it like that. And that's the contribution is what pays all your fixed costs. So let's just check our work, see if I made math there. All right, let's go on number two. Now this method, the high-low, let's look at a graph, if you don't mind. The high-low takes the units produced and the maintenance cost. Units produced for different months and the maintenance cost. So let's apply that to this. Units produced is the x-axis, and your cost is the y. So it plots these. So what did you produce that month, and what is your cost? And remember, look, so remember this graph. There's a graph of the fixed cost. Here's your variable cost, and this is your sales line. Now, as you produce more and more, or you sell more and more in this case, or produce more and more, what is the only cost that changed? Does this one change? No, only the variable cost. So the slope of the line is your variable cost. Now remember, we added them together. We added the fixed plus variable equals our total cost line. Total cost line right here. That's our total cost. So remember, the slope did not change. So your slope is your variable cost. If you make one more unit, one more truck today, the only additional cost, incremental cost, are all those variable costs. The fixed cost didn't change. The rent didn't change today. All right, so let's go back to our work. So the high-low, let's see. So we want to change. So essentially for math, remember it's the rise over the run. So the rise is the change in cost divided by the change in cost. Let's see what we want. Change in cost divided by change in production. Let's see here. Change in volume. Does it give us that? High-low method. Change in cost. Change in volume. So the cost at the high minus the cost at the low divided by the change in volume at the high minus the volume at the low. Okay, so in our case, the change in cost, the highest one is 74.10 minus the lowest one is 34.50. So my rise is 39.59 if my math's right. Let me just do it one more time. 74.10 minus 34.50. So 39.60. I got a different answer. I better do it again. The highest is 74.10 minus 34.50. So there's my rise in cost. But what was my change? 230 minus 50. So I changed 180. So there's my rise over the run. Okay. So now it's done the math. The change in cost divided by the change in production is my variable cost. So let's just now down here, they're essentially making you just work it to see if it comes out right. 74.10 and let's see, what were the costs at the low? 34.50. So there are my two costs. What is your volume at the high? 74.10. And what was your cost? Oh no, volume at the high. Oh, let's see, volume at the high was 230. At the low is 50. All right, and total variable cost at the high. Total cost at the high were 74.10, and total variable cost at the high. Well, I thought that's where I put the 10. No. Let's see what the fixed. Oh no, it wants us to calculate. Let's see. Total cost at the high are 74.10. Volume at the high is 230. Variable cost per unit is 22. So let's see. 230 times 22 is the 5060. So that means the total cost at the high, 74.10, minus the variable cost at that point means the fixed costs are 23.50. Now let's see if we can prove that. The variable at the low, the volume at the low is 50. And at 22 means 1100. So you see, we just proved by doing the math at the high and the low that the fixed are 2300. So if you make nothing, you have costs of 23.50. If you make one, your costs are 23.50 plus one at $22. All right. All right. So let's check where it works. See if I messed up anything here. All right. Very good. Let's go on to number 3. Contribution margin per unit of break even. Company sells its waterproof cases for $95 per unit. Fixed costs are this. The contribution margin has to be our sales minus our variable cost. So our sales are $95 each. How many do we sell? Does it tell us? So let's just have, if it doesn't give us the total, we have to put per unit. So our variable are 38. So our contribution margin is 57. Now determine the break even. You take the total fixed cost divided by, and don't forget, you've covered your variable cost, the cost of the pizza or the hamburger or the beer. Now you take your fixed cost divided by that. So if you only sell one, you've only covered $57 of fixed cost. If you sell two, you've covered 114. So fixed cost divided by the contribution margin. Well, what are your fixed? 119,700. Your contribution margin is $57. So we break even at 2,100. So what are our fixed divided by our contribution per unit will give us our break even in units. Now, the let's see here. Let's try number 4. And remember, we looked at it this way. Remember Colorado State University? We had the break even. So if you don't, particularly that one's hard to follow, you can look this one up, right? There's your fixed cost. Remember, if you sell none, your variable costs are 0. So your variable cost will start at 0. Okay. Well, what else starts at 0? Your sales line. If you sell nothing, so your variable cost and your sales line will start at 0. But your fixed cost will always start at the y-intercept because you have to pay that $4 or whatever it is regardless. Then this graph, it starts here is they've taken your variable cost, move that slope up. You notice the slope's the same. So you start at the fixed point of 4 or whatever it is plus your variable. So if you make 2, you have that variable cost plus this. So that's why you're up here. And then this is your break even. So many ways for you to look at this. All right. So let's see. Okay. So mine, I lost the graph. Okay. Let's go on to number 4. Sells its waterproof phones cases for 124, fixed cost, variable cost, contribution margin, ratio, and break even. I'm not going to do this, and I think y'all know how to do that. Contribution margin ratio, Sales minus variable cost, okay? And the contribution margin ratio is, uh, remember the contribution margin that you're making, right? You're making per unit. Hey, I'm making $4 on every pizza divided by what your sales are, okay? Your selling price. And then the break even is the fixed divided by that. So let's go on. You've already done that one. Now, the margin of safety is how much you are above the break even. So over here, if we go to here's the break even at 8 hot dogs, right? 8 hot dogs. Well, I'm up here at 2, at 10. I'm sorry. See, I'm $10, 10 hot dogs. Break even's at 8 hot dogs. So remember, my margin of safety here, I'm only 2 hot dogs above. And 2 hot dogs divided by 10. So my margin of safety is only 20%, right? I'm at 10. My break even is at 8. That's only 2 hot dogs. So I'm only above margin of safety is 20%. Now in this case, you see it's this how much, if this is the break even, see this is the break even, how many units are they? What percentage of safety do they have above that? All right, so let's go calculate this. And now you're just going to have to calculate it. What you have to do is you're going to have to figure out break even. So you have to take fixed costs divided by the contribution margin, which is 185 minus 121. 185 minus 121 means I'm making $64 per unit contribution margin. Divide that into this. Let's see if I did it right. Let's see, 185 minus 121 is $64. Did I do? Let's see. 185 minus 121 is 64. So I take 416,000 divided by 64 is 6,500. 6,500. Oh, I'm at 10,000 though, and I'm selling 10. So I'm 3,500. So I'm at 35%. Just 3,500. I'm at 6,500. So I got 3,500 divided by 10,000. So I got 35%. So how many units is that? 3,500. Well, multiply that times the selling price. 3,500 units, because I got 6,500 to break even, and I'm selling at 185. So mine is 647,500. And let's check my work. Very good. Now the sales mix. Sales mix. So here, what it's doing is it's saying that they sell these computers and smartphones in a ratio of 5-3. So for every 5 computers, they sell 3 smartphones, and the fixed costs are there, and the contribution margin for 5 of those and 3 of those is 134. So there again, take, let's see, choose the break even. Let's see, determine the break even in composite units. Fixed costs divided by contribution margin. So let's see what this is. Fixed costs are 124,620, and the contribution margin composite is 134. So that's 930 composite units. Now they're selling in the ratio of 5 computers to every 3 smartphones. So 5 computers to every 3 smartphones. That's 8. Oops. I don't know how they got over there. What's the composite units to break even though? Let's see. So it's 930 and 930. So now you have to multiply. So let's see. 5 times 930 is 4650. Just let me enter that. And then 3 times 930 is 2790. So there's my total units. So let's see, 5 to 3 is 8. Here's my composite units. For every 5 of those sells 3 of those. The composite unit for 8 units is contribution margin per unit is the $134 right there. All right, let's check how we do. Fixed costs per unit. Choose the numerator. Now, well, how can we get part of them and not those? Okay, let's see. So we have, oh, I know what it is. Instead of fixed cost per unit, it's just total fixed cost. Sorry. Or yeah, there you go. Total fixed cost. So now the composite units, now why did it not like it? Oh, look, I just put the wrong thing there. You see it? You see I had two more, 24, 7, and 9. So let's check now if that was what I did. So over here, I put fixed cost per unit. It's total fixed cost. And how come, let's see, 930 times 3 is 2790. Yeah, see, I entered it wrong again. It should be 2790. 3 times that is that. So my algebra is wrong. So fix that and we'll be okay there. Let's go on to number 7. Now, I would like to share with you something about absorption costing. Absorption costing includes everything. So let's see, do I have an example of that? I don't know why. Let's see if I can show you something here. See, absorption costing includes all of the direct costs associated with manufacturing, while variable can exclude some direct fixed costs. Variable cost includes all the variable direct costs and cost of goods, but excludes direct fixed overhead. Okay, so now we'll come back to that. But in this case, it includes this fixed overhead of 200,000, but you got to divide it by how many units you produce. So you got to take the direct materials, direct labor, plus the variable overhead, plus the fixed overhead divided by how many units. Okay, so I'm going to start off with that one. 201,600 divided by the 24,000 units we produced gives the fixed overhead of 840 per unit, plus the 1040 variable overhead, plus the $20.40 direct labor, plus the 1040. So this cost should be $49.60 if I did all my math right. Let's check it. So again, remember the difference between absorption and variable, it uses every cost. Now number 8 is a variable, so you can use that overhead all there. So you don't even use in variable costing, you don't consider that one. So you just add the first 3, the 1070 materials plus labor plus variable overhead. So it's 4210. It doesn't consider that. So right there. All right, let's try this, see what's next. Variable costing income statement. Well, so again, you're always going to start off with sales minus your variable cost. Well, what do we have variable? Variable cost of goods. Goodness. Why don't I have my this? I want variable cost. Okay, variable cost. And then I want my variable overhead. Do I have variable overhead? Fixed overhead, fixed selling. I want my variable production, and I want my variable selling and admin. Okay, right? And that equals to your contribution margin. Or let's see, I guess okay, that's equal to contribution margin. Contribution margin, and then down here, I want my fixed. I want my, where am I at? Let's see. I want all my fixed cost. So sales less my variable cost. I want variable production, variable selling equals contribution margin. Did I put contribution margin up here? No. Do they want total variable cost there? Yikes. Okay, let's see. Huh. All right. Let's put that there. So here's my total variable cost. And that subtract that, and that's contribution margin. Then I want my fixed cost less my fixed expenses. And what are they? Well, I have fixed overhead and I have fixed selling and admin. So now you can you're just going to have to take and multiply. Manufacturing recommend operation area produced 6,900 and sold 5,800. 5,800 times $99. So that's 574,200. And it sold 5,800. 5,800 times my production cost of 25.90, 150,000 there. And selling admin is 290 for each one. So 16,820. That do any math for me at all? Yeah, at least it added those up. So my contribution margin is going to be the 574,200 minus my variable cost. And so I got a contribution margin of 407,160. But now I have to take my fixed overhead. How do I get my fixed overhead? Fixed overhead up 95,910. And how about my variable fixed selling? There's 66,100. So total deal. And then 407 minus my 162,010 is equal to my net income, 245,150. Now let's see how we did. So variable up here, fixed are down here. This is a variable costing. This is variable costing right there. Okay, very good. Now, this is for management. This is for internal use. This is not what you produce to the world. This is for inside your company. Now let's go on to absorption, because this last one is what, you know, all the world uses. And I'm going to click over here. Let's see. Well, let's do this. Let's see. We still have sales. But what is up here? What do we have up here? Cost of goods, right? Equals cost of goods sold. So let's see. So what are they asking for? Sales minus cost of goods sold is equal to our gross margin. And down here, our selling and admin are going to be our, let's see, fixed selling. And let's see, do they have variable selling? Yeah. Here, less cost of goods sold. So what is cost of goods sold? It should be your variable, your fixed overhead and your variable production. Okay, that should be the total equals your cost of goods, and then down here should be your selling and admin. So we don't, variable overhead's not it. So you should have fixed selling, variable overhead. Oh, there it is, variable selling. So let's try this now. So here we sold 4,400, produced 4,400. So we sold 4,400 times a price of $85. So there's our 374, and our fixed overhead, 68,750, and our variable production costs are, let's see, our production costs are 2,450. But here, what absorption though uses everything. So it's not just what you sold. So I'm going to multiply by the 5,500, because I believe it includes everything all your costs, not just the ones you sold, but also the ones you made that did not sell. Now down here, your fixed selling and admin are for 64,700. Did I do it right? 64,700. And your fixed overhead, we have those. But here's your variable selling. So they're 4,400 times $1.50 each. So that's 6,600. So let's see now if we did this right. 374, or if I did it right, not we. Minus 203,500, 170. So I'm going to put 170 there, 500. Minus the 71,300 equals 99,200. So I'm going to see my work. Got my hands crossed. So less cost of goods. So it likes what we put the fixed selling and the variable selling down here. So whereas over here in number 9, we put all the variable up here and all the fixed down here. In absorption, it likes the fact that we put fixed overhead and variable overhead. It didn't like the numbers I came up with. But you see, this is just production cost, and now selling it down there. So this is your cost of goods sold. So let me see. Let's go back there and see if I can see what I missed. So in this case, a manufactured tennis rackets produced 5,500 rackets. Each racket was priced $85. Fixed overheads are 68,750, and fixed selling, that belongs down there. The company also reported the following per cost. Production are $24.50 variable production times 5,500 is $134,750, and 2450 times 4,400, which is only what we produced, would have only been 107,800. I don't think that's right. And they're saying the fixed overhead are 68,750. And it liked the titles, so it did like that being multiplied by only what we sold, the variable. But what is the problem with 68,750? Administrative costs. The company also sold production selling. Well, I'm not sure, so I've got to go back and I'll bring that. All right. So now fixed overhead is 68,750. I don't know what I'm doing wrong there. 68,750 fixed overhead. The fixed selling, no, we don't want that. Variable production, we got that. And the variable selling, we got all that. 68,750 fixed overhead. 68,750 is divided by 5,500 rackets. Then multiply by 4,400. Let's see if that's what they want. So that would only see, so what I'm going to do here is 55,000. Okay, so 374 minus 162,800 equals 211 minus 71,300 is 139,900 and 60, and that's 71. So what it is they had wanted me to take this fixed overhead is for producing this many rackets and then multiply by 4,000. So my fixed overhead divided by what I produced times what I actually sold. So it wanted here the variable cost per what I sold, but you had to divide that one. All right, so now I want to share with you one other thing before we go. Did it not show it? Did I lose it? Top 8 differences. Let's see. Well, let me text here. Now, I would like to share this with you. Cost. Variable costing includes only variable. Absorption costing includes both variable and fixed related to production. So see there, absorption includes this. Alternative names. Variable costing is also known as marginal costing or direct costing. And y'all talk about marginal costing in economics. Absorption costing is also known as full of costing. Variable costing is used for internal, inside, managerial decisions. Absorption is used for reporting to external stakeholders. It is the line in GAAP. You see, and I brought that up here. Here's D.R. Harton. And I go to the financial statements. And here's the income statement. Revenue minus cost of sales. See, it doesn't say variable cost. It's cost of goods. And then it's selling and admin are down below that. So that's the GAAP method. Absorption is what y'all see on GAAP. But variable is used in, okay, I want to go, why does this keep, just wanted to sell me some, I guess. All right, so now absorption is used for calculating per unit cost based on all costs. So take the cost divided by it, you got per unit. Variable cost is used for comparing the profitability of different product lines. Variable cost is based on internal specifications. Absorption cost is based on external reporting standards. And variable cost involves only the variable production cost to be assigned. And absorption cost absorbs all production costs and includes them in inventory and work in progress. It's used to calculate the net profit, but variable costing calculates the contribution, which is the difference between the sales and the variable cost. And lastly, profit. It's much easier to predict as a function of sales and variable. It's much more difficult to predict. All right, so we'll stop here with this one, and hope this helped you with Chapter 18.